Mr. Vikram Pandit, distinguished guests, ladies and gentlemen, it gives me great pleasure to welcome you to this Citi Bicentennial Lecture. My name is Kishore Mahbubani, and I'm the Dean of the Lee Kuan Yew School of Public Policy. As you all, some of you know, whenever I speak at the Lee Kuan Yew School, I make 3 points in my introduction. And the first point I'm going to make is that it is truly a great honor for the Lee Kuan Yew School of Public Policy to host this bicentennial lecture. And I really mean it, because if you look around at the banking world today, very few banks survive 200 years. So a round of applause for Citi for surviving 200 years. And as I was telling Mr. Vikram Pandit when we were chatting in the office, that this is actually the second time when the Lee Kuan Yew School has had the honor of hosting a major lecture like this. A couple of years ago, Sam Palmisano, the CEO of IBM, came here, right here at this stage, to deliver the centennial lecture for IBM. And we are really honored that, again, he chose our school. And what's remarkable about this is that when a major institution from the private sector, whether IBM or Citi, chooses to host a lecture in a school of public policy, it's actually a sign of the times, because it shows that in the world that we live in today, what you do need is cooperation between the invisible hand of free markets and the visible hand of good governance. So this is what the world needs, and hosting a lecture like this is a perfect illustration of what the future is going to be like. Now, my second point is about the topic. As you notice, Mr. Vikram Pandit has chosen a very diplomatically worded title, Responsible Banking in a Network World. Again, as I was telling him in my office, banking used to be a very boring profession. Those were the good old days. But now, as you know, I mean, this is not a great secret. As you look around the world, especially after the financial crisis, banks everywhere seem to face real challenges. They are in the news, sometimes for the wrong reasons. I asked my research assistant to say, just give me a list of the banks that have been mentioned publicly for having some problems. It was an amazing list. It has Standard Chartered, Barclays, JP Morgan Chase, Lloyds, ABN AMRO, Goldman Sachs, Bank of America, HSBC, Credit Suisse. Citi was not on the list. It's good you're not in the news. So, but it does show that this is actually a major topic that we need to address. What's happening? Why are banks facing these problems? And so this is a topic that we're not just going to address today, but we're going to continue to address at the Lee Kuan Yew School of Public Policy. In fact, I announced today that on September 17th, the former governor of the Swiss Central Bank, Philipp Hildebrand, will be coming here in this room to address the topic, can banks regain public trust? So this is a topic of our time, and I'm glad that Mr. Vikram Pandit decided to address it here in our school. Now, my third and final point is about the speaker. As you all know, is the CEO of Citi, the world's global bank, with approximately 200 million customer accounts and activities, and in more than 160 countries and jurisdictions. Vikram was born in India. He moved to the United States at the age of 16. He enrolled in Columbia University and earned both BS and MS degrees in engineering. And he received his PhD in finance from Columbia also in 1986. He joined Morgan Stanley in 1983 and ultimately rose to the post of president and Chief Operating Officer of the company's institutional securities and investment banking businesses. He left Morgan Stanley to become a founding member and chairman of the Members Committee of Old Lane. Indeed, I mentioned to Vikram that when I was going through my cards box, I found a card from him from Old Lane. That's where I guess we first met. And when Old Lane was acquired by Citi in 2007, he became chairman and CEO of Citi Alternative Investments. He later led Citi's Institutional Clients Group, and on December 11, 2007, was named Citi's CEO. And upon his appointment, and I did say to him earlier, it's quite remarkable. He took on the most difficult job at the most difficult time of Citi for $1 a year. So let's applaud him for being a role model. But believe me, when he took over Citi, it was a remarkable challenge that he faced. I remember very well-informed observers questioning whether or not Mr. Vikram Pandit could do it. And I can tell you the verdict is now clear. He has succeeded. The bank is back in strength. And that's why we're truly delighted here to have you with us, Vikram. Welcome to the podium.
Thank you, Dean Mahbubani. That wonderful introduction, rather complete as well. You know, I said to the dean earlier when we were talking in his office that you know, for anybody who agreed to take on that job for $1 a year, it should have been grounds for disqualification immediately. Having said that, we are in a different place, and I appreciate your mentioning that. It's great to be here with all of you. Pleasure and quite an honor to address you. And it's inspiring to be at this great institution, an institution that has trained incredible talent in Singapore, and talent that has had an incredible impact as well. And for us at Citi, this has been our home. This has been our home since 1902. We've been in Singapore for 110 years through thick and thin. And today, we employ about 10,000 people here. Many of them to serve our clients that are in Singapore, but many also to provide the kind of services and resources we need to run the rest of the businesses that we have around the world. And with 10,000 people here, that makes us one of the largest private sector employer, I think only smaller than Singapore Air here on the island. This is our 5th largest base of operation in the world. We offer our clients and customers here everything and anything we offer them anywhere else in the world. So we offer them a full range of services, retail branches, credit cards, cash management, private commercial banking, corporate banking, investment banking. And as I said, Singapore is not only the financial capital of ASEAN and South Asia, but for us, it's also the home base from which Citi's processing and data centers service businesses and clients in over 60 countries. So Singapore, as you can see, is very, very important to us, and so important that when we decided to have a board meeting outside of the US, our first one we held here, and that was almost a year ago to the date, is when we came here together. So today, I'd like to talk about a couple of things. First, I'd like to share with you a rather personal perspective of what it was like during the financial crisis and what Citi went through and how we emerged and how we're positioned for the future. And second, more generally, I would like to discuss some new ideas on how to bolster systemic safety in ways that I hope, if not prevent, can mitigate any future crisis. But to me, it was absolutely clear, following December 2007, when I became CEO of Citi, it was clear that crisis or no crisis, we had to restructure Citi. And while the crisis was a catalyst, the need was already there. the company had, in my view, lost its focus. It had lost its sight of its core mission and its core businesses. We had become a company that was probably too much focused on buying and selling companies, buying and selling businesses. It was about, let's put this together, let's break this up, rather than what the core mission of a bank should be, which is serving its clients. And when I became a CEO in 2007, figuring out what to do, to me, was the easy part. I knew that we had to get back to the basics of banking, back to Citi's core strengths. We had to put our capital to work for our clients. We had to focus on serving the real economy. This year, which is our 200th anniversary, is a year that is important to us because we're starting our third century with a company that's been restructured and a company that's back to focusing on its core mission. And in 1812, when we were founded by a group of merchants who needed financing. And essentially, what that means is that we were founded by our clients. We know what's worked for us in the past and what hasn't. Whenever we focused on our core mission, serving our clients' banking needs, we've thrived. And whenever we've strayed away, that's when we've run into trouble. So it wasn't very difficult to know what we had to do, but doing it was a little bit harder. The first thing I did was I assembled a core team, and this team was split roughly evenly between Citi veterans, people that were at the heart of what had made Citi an outstanding institution around the world. In addition to that, I brought about half of the management team from the outside. These were people I'd known for years, and they'd come with me to restore Citi's stature. We immediately began raising capital, and since that time, since the year end of 2007, we've added more than $140 billion to our capital base. And we changed the structure by identifying what businesses were core and which were not core to our strategy and historical strengths. In January 2009, that was about a year after I became CEO, I formally reorganized the company and split it up into two parts. The one part being Citicorp, which was our core banking businesses such as retail banking, credit cards, transaction services, institutional banking, and the other was Citi Holdings. And these were businesses as well as assets that we identified for sale because they were not core to Citi. That number at that time was almost $800 billion of assets and over 65 companies that were not core to Citi. And today, if you fast forward and look at where we are, Citi is smaller, simpler, safer, and stronger. Back in 2007, we employed 375,000 people. Today, we have 261,000 people. Of the $800 billion of assets we identified as not core, we've sold $600 billion of those already, and we've sold more than 60 businesses. And as a result, the non-core businesses of Citi are down to no more than 10% of our assets and about $200 billion in size. As importantly, as we've been doing this, because of all the capital raising and restructuring of the company, our capital strength today is more than 5 times higher than what it was during the crisis. We changed our risk management functions. They've been actually completely overhauled, and we've taken our risk down substantially. We strive very carefully to match our assets and liabilities country by country. A bank that is funded mostly by short-term funds, that also owns a great many long-term loans, will be in far more difficult position and far more complex to steer through a crisis than one whose assets and liabilities are much more evenly matched. With all of this in place, we've got the results, and the results, which have been 10 straight quarters of profitability, in many ways speak for themselves. Today, this strategy, the back to the basics of banking, back to our historical strength, is consistent not only with our company's historical roots, but is also aligned with the trends that are defining the global economy. The two most important trends we see out there are the continued growth in the emerging markets, in particular, the rise of the emerging market consumer, and the unprecedented trade and capital flows resulting from globalization. We are probably the best positioned global bank to benefit from, and more importantly, to help our clients benefit from these trends. Citi is the only global bank with a large, long-standing presence, not only in North America and Europe, but also throughout Latin America, throughout the Middle East, and throughout Asia. We maintain an on-the-ground presence in 101 countries and jurisdictions, and operations in 60 more. We're uniquely positioned to facilitate global trade, global capital flows by helping our clients enter new markets and expand in existing ones. There's no other global bank that has a stronger presence in the emerging markets, and we are positioned to earn an increasing share of the growing trade flows within the emerging markets. One of the biggest trends that we see is an exponential rise in trade, south to south, Latin America to Asia, Asia to Africa, Africa to Latin America, and those emerging market trade flows are happening today point to point. None of them are necessarily trade flows that have to go through London or have to go through New York. This is the network world in which we live. Now, we understand banking to be both a public trust as well as a public good. I think we all recognize that the financial system is absolutely essential to the global economy. We all benefit from it. And in that sense, and it's sort of the classical case of a public good. But our financial system is also a public trust. It's mostly privately owned and mostly privately operated on the free enterprise system of private profit and reward. And that's how it should be. But because the system is so essential to everyone's standard of living, even to the political stability of countries, those who run the financial system share a profound responsibility to keep it safe. And it's this topic that I'd like to spend the next few minutes on. We at Citi have been thinking about this issue a great deal over the past few years. We worked and continue to work very closely with regulators to improve the oversight of the financial system. Citi has been a strong supporter of financial reform since the crisis, and we think that the construct that has been built by the regulators and the financial industry around the world coming together is a construct that should work. The reforms put in place since the financial crisis mostly strike the right balance between the needs of the economy and the safety of the system. This framework boils down to 4 core principles. The first is capital, ensuring that banks hold enough capital to absorb shocks, ride out rough patches, and remain able to serve clients with no disruption through any and all economic environments. Basel III and the Financial Stability Board's rules and regulations address this issue very well, though there are some concerns about calibration, how certain types of assets will be valued for the purposes of calculating a bank's capital strength. A calibration that recognizes the economy's need for capital while preserving the ability of banks to lend should be the goal for all of us. The second is liquidity. Basel rules will also impose the liquidity standards on banks and how that liquidity is invested. And even before the enactment of these rules, banks generally around the world are by and large more liquid than in the past. At Citi, for example, our liquidity pool today stands at more than $400 billion, which is conservatively positioned and primarily invested in cash and highly liquid government securities. The third is resolution planning. And this is something that's required by the American Dodd-Frank law, sometimes referred to around the world as living wills. These are detailed plans that banks must submit to regulators that explain how, in the event of a looming failure, a bank can be recapitalized or can be wound down without systemic disruption or taxpayer support. And we just submitted our plan. And by the way, it ran 2,300 pages. And by the way, that's not even the longest one submitted. But it does provide the information that is necessary for regulators and executives alike for a roadmap that can be used to help resolve a bank should the worst happen. And resolution planning, if done correctly, as it will be, should end too big to fail. We're also cognizant of the fact that there are banks like ours who are global, and so we have to coordinate our resolution planning across all material legal entities and all the jurisdictions in which we operate, and we're planning to do exactly that, make sure that these resolution plans are known to every regulator we have around the world, and Singapore is one of the first stops for us to go through that. The fourth principle is simply strong supervision, both internally and externally. I think the recent reforms in many parts of the world have accomplished that on the regulatory side. In addition, banks have responded to the crisis and to the new wave of regulation by enhancing board supervision and strengthening corporate governance. And the move towards greater transparency through greater disclosure, which, by the way, we applaud, also imposes more market discipline. Taken together, these reforms, right from regulation to what corporations are doing, to what the markets expect, together constitute the biggest package of regulatory overhaul and governance changes since the Great Depression. And while governments and private financial institutions have accomplished a great deal over the past several years, we must admit that there is still much unfinished business. One major concern that should trouble all of us is the amount of capital that is today flowing into the unregulated financial system, sometimes known as shadow banking. Since 1990, the size of the non-bank financial sector in the U.S. has risen from half the size of the total financial system to 2/3. In other words, everything I've just talked about in terms of regulation only applies to 1/3 of the financial system in the U.S. Identifying and properly regulating non-bank financial institutions are vitally important tasks. Every piece of regulation we're talking about has but one goal: to enhance the safety and soundness of the financial system. But this goal is unlikely to be achieved if all that we accomplish is to impose more requirements on the formal banking system and the formal banking sector while leaving the non-bank financial sector relatively untouched. What does happen, and what is likely to happen, and we've seen this before, is that costs and restrictions imposed on the activities conducted by the regulated banking entities will push those activities into the unregulated and less regulated financial entities. As a result, not only is risk not reduced in the system, it may actually rise as the non-bank financial system expands and the incentives to embrace risk there increases. And investors are smart enough to recognize this opportunity. And today, when you look at some of the stocks of companies that operate in the shadow banking system, they've risen 23% so far this year, while the rest of the regulated banking system is challenged. So a level playing field is essential for systemic safety. While we've been talking about this, so far we think there are just too few voices recognizing its importance. Making the same or similar rules apply to the whole system should be at the top of the agenda. Otherwise, all our great work could be for naught. I kind of liken it to a house with the finest lock on the front door, but the window open in the back. Given the sheer size and complexity of the shadow banking system, direct supervision alone is not a practical solution because there are hundreds, if not thousands, of shadow banking entities. It's impossible even for the most effective regulatory body to see everything, every transaction, every trade, every asset, every loan. One approach that could address this is stronger product regulation. For instance, consumers tend to assume that a credit card with the lowest annual percentage rate is the best, but that's not always true. In the US, we at Citi offer a product called the Simplicity Card. This is a product where consumers are not charged any annual fees, any late fees. They're not assessed any penalty rate hikes, nothing. It's just one rate. It just happens that that interest rate is higher than the rate for many other cards. But for a customer used to being charged those fees, the actual cost of using this card is going to be a lot lower. Similarly, when buying a car, a consumer is likely to choose the financing plan with the lowest upfront cost. Yet once every other cost and fee is factored in, the car with the lowest monthly payment is often more expensive than the one parked right next to it with a higher monthly payment. Think of the pre-crisis explosion of adjustable rate mortgages, no down payment loans and the like. They looked cheap, but they turned out to be very expensive and turned out to be the heart of the crisis in the US. Many countries, especially here in Asia, have addressed this problem by setting loan-to-value ratio for mortgages. These countries have clearly decided that it's not enough to leave things to caveat emptor. Some of the real-life patterns we see in consumer behavior lead to decisions that harm individuals' balance sheets and threaten systemic safety. As we learned from the credit crisis and housing bubble in the US, bad individual consumer decisions are not necessarily isolated events that hurt only the decision makers. In the aggregate, they can often threaten the prosperity of an entire global economy. The point of rules against this kind of behavioral arbitrage is less to protect individuals from their own poor decisions than it is to protect the rest of us. Safety and soundness can't be accomplished through regulation alone, although regulation does provide the architecture and the backbone for safety and soundness. Banks do have, in addition to that, core responsibilities that we must all meet, and none of them is more important than establishing and maintaining the right culture. Systemic safety relies on the culture of each individual bank, each individual financial institution. If that culture is sound, the bank will be sound. The more banks have a strong culture, the safer the system will be. It's probably as simple as that. The heart of Citi's transformation since 2007 has been our cultural transformation, or really a restoration of our culture. We had to realign our culture with the strategy. Essentially, our strategy today is an updating of the strategies that saw Citi rise to worldwide prominence under our legendary CEOs George Moore, Walter Wriston, the same culture that made this bank great, client-driven, focused on the basics, dedicated to serving the real economy, is the culture we set about rebuilding. If there's one phrase that defines our culture, it's responsible finance. And that means that for everybody at Citi, they have to ask themselves 3 questions before they serve a client or enter into a transaction with a client. 1, is it in my client's interest? 2, does it create economic value? And 3, is it systemically responsible? And the answers to all 3 questions must be yes for us to do that transaction or to serve that client. We have, and we will again, turn down business that doesn't meet these criteria. We've also made sure to incorporate these responsible finance metrics into our employee assessment process, our compensation processes, our promotion processes, and we've linked all of them together. Serving our shareholders, clients, customers, while important, is just not enough. It is every bank's responsibility to do what is right for the safety and soundness of the financial system as a whole. And our concern for that systemic safety extends well beyond simple attention to the bottom line. For 200 years, our core mission has been to enable progress for our clients. This June 16th, this year, we started our 3rd century as a bank. In those 2 centuries, our bank has built an impressive record of achievement. We've financed some of the world's most transformative projects. We've been through panics. We've been through wars. We've been through depressions, and we've always emerged stronger than before. We as a bank have survived. We've thrived by meeting our responsibilities to our clients and to our communities. So some of these proposals that I have discussed today to bolster systemic safety and systemic soundness are our part of our commitment to responsible finance. And I don't pretend that they are necessarily the last word, but we do hope that they will contribute to a fruitful and a very important conversation for all of us. Again, it's a pleasure to be here with all of you. It's an honor to address this group. Only in Singapore can you get together the kind of talent we have here. So thank you again. That's great.
Thank you. That was a great beginning overview. Now, the floor is now open for Q&A, but I'm going to take privilege of my position as chairman to ask you the first 1 or 2 questions.
We'll make it easy.
No. We got to keep up the reputation of Lee Kuan Yew School of Public Policy.
Absolutely, absolutely.
The first question is actually the one that builds on what you said about regulation. Now, you are probably the most globalized bank, or one of the most globalized banks. You have to deal with so many regulatory authorities. Are you better off in a world where you have many, many different regulatory authorities or greater harmonization of standards? What's your preference as a global bank?
Well, you're right. We are in 160 countries. By the way, that's at least 160 regulators. And in many countries, there's more than one. I mean, you go to the U.S., we believe in competition in anything, we also believe competition amongst regulators, right? And so just in the U.S., we have multiple regulators, which on one hand keeps you on your toes. On the other hand, it does require a lot of coordination. I do think we've got to be practical. I think we are here in Singapore, and it's important for us to interact with the MAS. The MAS looks after us here, and whether or not we had one regulator around the world, the lead regulator in Singapore should still want to know what we're doing, how we're doing. So the practical answer to this is exactly what you said. We need a lot more harmonization and greater coordination of the regulatory structures around the world. And that's especially true if you think about things like resolution planning and recovery if something goes wrong. One of the aspects of that has been occupying the regulator's mind is what happens if a bank fails and if a bank has operations in a few countries. It doesn't have to be as big as ours, but 3, 4, 5 countries. What do you do? How do you interact with the regulators in the different regions? And it's on one hand easy if you have a resolution plan and everybody holds hands and says, you know what, we'll work together with you, the lead regulator. On the other hand, it could be awfully difficult. We see this coming together in the form of the College of Regulators. We see this come together in the form of the Financial Stability Board that's been established in Basel. And a big part of the objective of these convenings of regulators and these bodies is to do exactly that, harmonize regulation around the world. We still have a long way to go, for sure.
Great. The other thing that struck me in your speech was your comments about the shadow banking system, which you said has grown so much. But you also said it'd be difficult to regulate them. So if regulation is not the answer, how do you control the shadow banking system? What mechanism do you use?
Well, and that's a very good question. It is a difficult question. There's no making light of the magnitude of this, because one of the wonderful things about regulating large banks is you know where they are. Okay, and you can go and say, that's a large bank, let's regulate them. And when you think about the shadow banking systems, it's hundreds and it's thousands of institutions around the world. And how do you get at them? And how do you get at them to do the right things? Practically, here's what it comes down to. And this is a topic that the Financial Stability Board is keenly aware of, and they're paying attention to it. And you're going to get a lot of good ideas and good regulation coming out of that. It's going to fall in three buckets. The first is product regulation. And we talked about this on the consumer side, but let's take an example. Some of you know things called money market funds. These are funds that are places where you can put your deposits. Rather than going to a bank and getting whatever interest rates you get nowadays in Singapore, which is very low on your bank accounts, you can go into money market funds.
Can you raise our interest rates a bit?
Well, the cost of regulation is going up, Kishore. But so you go to a money market fund and they give you a higher interest rate and then make you believe that your money is safe. Yeah. Now, that sounds to me like free lunch. I mean, I think as an economist, you say you cannot have that disparity. But what's really happening is they're giving you an implicit guarantee that you're not going to lose your money. That's unless something goes wrong. And the way you get at it is by regulating money market funds for the products they offer, by saying that it cannot be an implicit guarantee. It has to be something that people who put money into money market funds say that I could lose my money. That in itself regulates the kind of people who put money in there, their loss tolerance, and it completely changes the equation. That's product regulation. The other is market regulation. One of the areas that requires a lot of work around the world is derivatives. There are trillions of dollars of these. And by the way,
somebody called them weapons of mass destruction, right?
Well, let's call them.
He was sitting in your chair, by the way.
Was he really?
Volker.
Can we switch chairs? Okay. They serve an important social purpose. They allow you to manage your risk. They allow you to insure yourself against events that you may not want to face up to. So there is a social purpose, but there's a right way of doing it, which is making sure every derivative goes through a clearinghouse and goes through an exchange. That's called market regulation. You can do that. By the way, that makes the shadow banking system a lot safer. And the third is transparency. Whether you're big or small, you should have requirements to publish certain financial information, certain risk information, not necessarily with a view that you're going to regulate every entity in the shadow banking system, but at least have that information out there so that investors can look at it, market participants can look at it, and regulators can look at it to see if there are issues that arise. Those are three very practical ways in which you can really chip away substantially at these issues that are posed by the shadow banking system.
Great. Questions? Yes, please. If you don't mind, Preeti, just to remind everybody in the audience, good question has three parts. First, you identify yourself. Two, you make it brief. Third, it must end with a question mark. Preeti, my former colleague, please. Preeti, identify yourself for Vikram. Yeah.
My name is Preeti Davra, and I currently write for the Wall Street Journal Mint in India. My question to you is that you have obviously undertaken a spectacular reform change management process at the bank. Why is it that other CEOs today are not doing that or have not done it in the recent past and are suffering the consequences? Is there something unique about Citi that cannot be undertaken in other banks?
Well, one thing I never do is talk about my competitors.
Except to say you're better, that's all.
Well, I think for us, as I said, a new CEO taking a fresh look at what the bank was, trying to understand what our core differentiator was, trying to understand why clients should use us was a good start. And most strategy and most changes, most streamlining, most focus starts with introspection, and we had absolutely no sacred cows. And I know a little bit about sacred cows, by the way. So, you know, we went through all of that, and it was very clear that when we looked at our history, looked at what we were good at, we were good at connecting the world for our clients and our clients to the world. And we said, that's our core business. And around that, we will provide both institutional and retail banking services, because that makes for a safer institution. And that was it. Nothing else really represented something that was core to us, and we decided to embark on that very importantly. But the other aspect that also came out of our history is what I talked about briefly, which is that the core purpose of banking is to support the real economy. If there was an Oscar in banking, it would only be a Best Supporting Actor or Actress Oscar. And that's all you should strive for, which is how do you support the economy? How do you serve your clients? Where the system went wrong was banks using its capital for themselves through proprietary trading and putting it to work versus putting it to work solely for the purposes of clients. Now, these were transparent things, and at least they become transparent when you're new in the job and you really don't have that legacy and history of trying to protect anything you've done. And we've managed to do that. But on the brighter side, I think when you look at what's going on in the banking system around the world, look here in Singapore. I mean, you've got some great banks here. Look in Asia. You can look in India. You can look in China. These are banks that are dedicated to the basics of banking and core principles of banking. And so when you look around the world, there are many banks who actually get it. And that, to me, is the powerful part of how we can, again, become boring as bankers.
Next question. Yes, please, gentleman over there.
My name is Lam Chi Chung. I'm a partner at Axiom Asia, an Asian private equity fund of funds. I think that was a very visionary statement for the future. I wanted to ask a question about the past, and I know, you know, a lot of it happened before you came on board. But I guess in terms of your kind of lessons learned of kind of what went wrong in 2007, you know, what would be some of the main takeaways at Citibank? And in particular, do you think the merger with Travelers Smith Barney, with 2020 hindsight, did that make sense? And how much of the 800 billion of non-core you identified, how much of Travelers, what percentage of Travelers ended up being non-core? Thank you.
You didn't put Kishore, you didn't put a limit on how many questions. All right, let me try and get to as many of those as possible. Look, I think in hindsight, it is probably clear that the Travelers merger didn't turn out to be everything people thought it was going to be. And today, as a result of actions taken even before I got there, and all the actions that I've taken since there, basically, we're back to what Citi was prior to that merger. Yes, we have some additions in some of our capital markets capabilities that came from there, but these are capabilities Citi would have built anyway over time independently in response to the market. And so the focus of that merger, which was supermarket banking or financial supermarket, is a strategy that I don't believe is right for the times. And not only that, I don't believe is right for our bank. And that is a strategy that required us, getting out of the strategy required us to do everything we've done and now refocus on what is really the core banking business of the institution, which differentiates us. You know, I think the broader lesson, I'm not going to talk too much about Citi, the broader lesson on what happened in the crisis was an overbuilding of real estate, financed by the financial system. And for many banks, a concentrated exposure to that real estate. And in some cases, financed by short-term debt and short-term funding rather than long-term funding. So imagine a picture of concentrated risk on your balance sheet to US housing. Housing dropping 40% in price, and having funded yourself with short-term funding versus having long-term debt to fund these long-term loans. If you have that, you've got a problem. And that's the problem we set out to clear up and to solve. And we did it first by raising, as I said before, almost $140 billion of capital. Just imagine that, $140 billion of capital, to make sure that we absorbed all the losses and recapitalized the company to be financially as strong as anybody else in the world. But surrounding that was recognizing that the strategy was not the right strategy for the company, which is what got us back to the core banking. And today, we are essentially the same strategy as the old Citicorp, tried and proven, and it works. It's simple, it's boring, and it goes to the heart of what we're good at.
Can I just push you a little bit on that lessons from the crisis? Because
the boring part, or?
No, the lessons learned. Because I think my sense is that the dust is still settling, and we're still trying to figure out what really went wrong. But you know, one of your predecessors, I think, had a very famous statement, something like, "As long as the music is playing, we'll keep on dancing," or something like that. And
well, I'm not a dancer.
I know. But I thought that one of the other lessons in the crisis was that the regulators should have intervened earlier and more decisively before the whole thing fell apart. That it was in some sense also a regulatory lapse that led to the crisis.
Well, I think there is no question that a lot of things happened to get us all to the crisis, absolutely. And there are lessons for everybody that was involved in that. Look, I mean, you know, I'm fond of saying to our people, I can have the best strategy in the world. I can have the best products for my clients in the world. You know, I can have the best solutions for my clients. Those are all good things, but those to me are hardware. And yes, you got to have great hardware. It's really important. But a great hardware is only as good as the software that you have to run it. And there are two critical aspects of banking software. One is culture that I talked about, but the other is prudential supervision. Both of these are the software that make the difference between a strategy that works, a system that works, hardware that hums, versus one that can have failure. I think that's abundantly clear to the world.
Good. Next question. Gentleman over there, please. Yes.
My name is Tufay. I'm a professor of banking and finance at NTU. Used to be
watch out.
used to be many years teaching at major US schools like Stanford and Michigan. As a middle-class saver, weren't you a little bit too critical of the shadow banks? Because while I used to live in the States, before I moved to Singapore, I discovered that the likes of Fidelity, Vanguard, and Schwab did everything for me better than Citibank or anybody else could ever do. And I miss those guys clearly here in Singapore, where I feel ripped off by the traditional bank every day. Could you comment on this, please?
Absolutely. Let's talk later. So look, I mean, I am not including the asset management firms as part of the shadow banking system. And if you did, that's not the system I'm looking at. The shadow banking system I'm looking at is a banking system that takes deposits, but it's not a regulated bank, that makes loans, but it's not a regulated bank. And by all means, wealth management is an area that's really not capital intensive. It's really about advice. It's about making products and services available. And today you'll find the banks are, and through their own transition as well, make these products and these services available. But by all means, if you prefer to use Schwab, go ahead. But again, I think this is what makes these discussions important. when you think about Fidelity, when you think about Schwab, when you think about Vanguard, Vanguard is an index player, as an example, an index fund. They do use a lot of the services in the capital markets to make the products for you to buy. They also use derivatives. They manage the risk correctly so that you can get an index tracking fund. Their safety and soundness is dependent on how safe the derivative market structure is. And that, in turn, is dependent upon how transparent it is and how it is cleared, how it is settled, and whether these things are on exchanges or not. So on the narrow point you said, I think these are great services that are offered by people trying to compete for your business. By all means, they're the right things to do. They're agency businesses. They're advice businesses. They're not what I consider shadow banking. On the broader issue, we still have to address shadow banking.
Hi, Mr. Pundit. Thank you for being here today. My name is Vaughn. I'm a college senior at Northwestern, graduating next year. My question for you is...
So now, how are you here?
I live in Singapore.
Okay, there you go. Great.
My question for you is, you spoke a lot about responsible banking, but how would you balance that with restoring shareholder value? And I ask you this as an investor in Citi.
Yeah.
Oh, yeah. My God.
Yeah, that's great.
Students are major investors now.
Yeah, first of all, thank you very much for being an investor. I appreciate that. Look, I think that notwithstanding what's happening with bank stocks today, I think it's important to recognize that a number of things that are affecting bank stocks, particularly in the West today. European risk being at the top of the list, really important. What's going to happen with the fiscal deficit in the US, and therefore the recovery, really important. I think it's also fair to admit that not all regulation is done. There's still regulatory uncertainty. There's questions about some of these rules. These are all material overhangs on the stocks. And while these stocks have done a little bit better lately, the fact is they're not trading nearly close to what intrinsic value would be on the basis of the services that provide the earnings they have. Put that aside for a minute. The question is really one of how does responsible finance and shareholder value come together, notwithstanding the stock prices and where they are today? And I think they're absolutely aligned. They're completely correlated. Because at the end of the day, the real business of banks is to serve clients. And we should be entitled to earn only that which our clients allow us to earn for providing value-added services. And that's what should create the profits, and that should be the basis of how the shareholders evaluate us. Okay. When you look at what's happened here over the last 3, 4, 5 years, and when you look at some of the losses that have been taken, some of the fines that have been paid, some of the litigation and the overhang that still continues, responsible finance would have been a shareholder-friendly act through history to ensure that they preserve their shareholder value. So not only don't I see a conflict, I think they're completely harmonious.
Thank you.
Next question. The lady over there, please. Yes. Yes, that's you. Yeah. Yeah.
Hi, Vicki Mayfield, former city employee.
Welcome.
One of your predecessors famously said, countries don't go bankrupt. But we're looking right now at the Eurozone, and how are you managing the risk there?
I think that's a very good question. I think that is, to me, probably the single biggest issue that is affecting global markets. The question about Europe, how is it going to get resolved? Where is it going to go? And look, we've been a firm believer that Europe needs the euro. Europe is stronger with the euro, and Europe's even stronger with a stronger euro. And there's nothing more we wish for and hope for than that to be true. On the other hand, as a bank, I've got to be ready for any eventuality. And that eventuality could be anything from some of the things you talked about that could happen to countries. And by the way, some of the debt was rescheduled. So it's not a event that hasn't occurred recently. But the other part of that is that the markets are extracting a huge price from some of these countries for convertibility risk. The currency may not be the currency. It could be something else. And so we as a bank have to have a contingency plan. What happens if there's a problem with the countries repaying their obligations? What happens if the euro is not the way it is? It's multiple currencies, not one. You have to have a contingency plan. And when you have a contingency plan as a bank, you've got to put it to work. And that's what we've been doing for the last 18 months. And so where we are today is our exposure to the sovereigns that are at greatest risk is negligible. Financial institutions, our exposure also is negligible in these areas. We actually go home, in many cases, owing financial institutions what they owe us every day, as an example. Most importantly, we made a decision some time back that if you had made a loan in Greece, you don't want that loan to be financed through funds that you raised in Germany. Because if something goes wrong, you have a Greek loan in its currency, and you're owing funding in German currency. The most important thing was to match assets and liabilities country by country. And so the net impact of all of this is that we've been getting ready for any eventuality of what happens in Europe, and that's kind of where we are as a bank. Now, that doesn't, by the way, we've done that. If every bank does that, it tells you a lot about what's going on around the world and what Europe has to deal with, and that speed is essential in trying to figure out how to resurrect confidence in the euro.
My guru, Satpal Kara. You got to listen to my guru to come. You come to the mic, Satpal.
Mr. Pandit, thank you for what you said. Now it's a client of Citi Private Bank who's asking the question. A number of jurisdictions and governments are insisting that you incorporate in the jurisdiction in which you operate. How does that fit in with Citi's new plan? Part of it is given in your answer that you want to match for instance, your Greece liabilities with Greek assets. But it's not always possible to do that. So a multi-dimensional approach is needed in order to this thing. I'd like to hear your views on how Citi is dealing with that problem.
Yeah. So we as a bank around the world have both instances of fully incorporated subsidiaries on the ground. We have a large one in Mexico. We've got one in Korea. There's one in Poland. I think Taiwan's that way as well. I mean, so we're doing that. Here in Singapore, we have both a subsidiary in which we run our retail business, and then we have a branch of our global business in which we run our trading activities, as an example. So I think those are important technical issues to deal with, but one can deal through them because at the end of the day, for us, the core principle is still asset liability matching country by country. That's really important. If you cannot do that, then you probably don't have the type of business you should have, or maybe you shouldn't be making loans in that country that you're in. And so when we look at how we run our businesses around the world, Greece is an example, right? Or Mexico is an example, or Poland's an example. We have the collection of businesses which are retail and institutional that allow us diverse funding sources, right from retail deposits, corporate deposits, funding in the capital markets, and we have a diverse set of loans on the other side, which are corporate loans, individual loans, as well as the balance sheet we have in running the capital markets business. That's a core principle for us. That's how we run the bank.
Gentleman over there, please. Yeah.
Hi, my name is Rajat Punshi. I'm the founder of the Operational Risk Practice, which is an operational risk training and consultancy firm out of here. Right. I had two questions. The first is, I'd like to hear your views on too big to manage, yeah, as opposed to too big to fail, right? And the second question is, from the time you took over, how's the conversation at the board level changed? Mm-hmm. Yeah.
the board conversation, I think, is important. The too big to manage, I think both of them are important. And you're absolutely right. I think the question about size of the institutions is more related to, with resolution, recovery planning in place, that ends too big to fail. The question is much more about, tell me how you can manage an institution of the size that you're at, et cetera, which is exactly why today we're smaller as an institution. We are simpler as an institution. We only have 2 principal product lines around the world. We're safer and we're stronger. The management issue, to me, has 2 components. One, what is your structure in place? And that's one of the biggest things that we did. We decided, by the way, that every function we have, like technology, like operations, like human resources, et cetera, ought to be centralized. And we run it from one place with one set of policies, one set of standards. Second is there are 2 global products. They're run with the same standards around the world with reuse of technology, as well as exactly the same standards by which we want to conduct business. And third, we have 4 regions around the world, and each region has a CEO. And the job of the CEO and local management is to ensure not only compliance with global standards, global policies, but that they are the ones responsible for operational risk on the ground. They are the ones responsible for meeting with the regulators and interfacing with the regulators. They're the ones responsible for making sure the operations work. So an architecture of that sort is a very simple approach to getting at how you run a global institution. And by the way, that's not unlike what you would see at Kishore mentioned IBM early, IBM or Exxon or a variety of different companies. It's a very simple architecture with clear accountability, clear responsibility. But the second part of that question does come down to culture. And that's really important. And it comes down to how you articulate your culture, how you carry it, how you train your people, as I said before, how you put it through performance evaluation, compensation, and promotions, and how you monitor that people are behaving the way you want them to. To do that, you've got to do 2 things. You've got to convince everybody in your organization it's in their interest to follow the culture. And the second thing you need to do is convince them it's in their interest to point out if they see something happening at the company that's not in line with our culture. And that's what we've been doing over the last 4 years. On the second part, by the way, the job's never done. I mean, that's a continual process. It's not a destination, it's a journey. And we keep doing that every day. This year, we just took up our training again in terms of the number of days required for our people to go through different ways of thinking about the business, different ways of running the business, but that's how you do it. For us, our size is determined solely by what our clients need from us, the services they want, the global multinationals. Given that, everything else I says follows. And that's our approach to managing the organization.
Please, gentleman over there, yes.
Raymond Kwong from VC.com. Mr. Bennett, I hear you say several times asset liability management is key, country by country. Also, you mentioned about banks, which is basically short-term in terms of assets, but if they start lending in housing, it's going to be a long-term liabilities. Can you share with us your view whether there is a amount of housing loan? Because basically, anybody want to buy a house, they go to the bank. So bank is an institution that provide that services. Is that a mismatch in terms of what you were saying? Or whether there should be some other institution which has got a longer term liabilities? I was from the insurance industry. We have a longer term, sort of mean term in terms of asset and liability. Whether some other institution is better to provide those services?
Yeah, well, I mean, there are lots of examples around the world. In the US, because of Fannie Mae, Freddie Mac, the government does it, right? I mean, they're the ones who are taking the asset liability mismatch in trillions of dollars. I think they've got if I recall correctly, $6-7 trillion of mortgages on government balance sheets.
But they're in trouble, right?
Well, you know, that's another asset liability mismatch question. But I think the core model of making long-term loans in banks is the following. Either you have retail deposits, because retail deposits tend to be very sticky. And they may be overnight, but on average, when you look at what happens, they're with you for a very, very, very long period of time. And so they're, realistically speaking, very much long duration funding sources. You can do that. That's the core banking model of deposits, retail deposits against mortgages. If you didn't want to do that, then you've got to go into the capital markets and borrow some long-term debt. And most mortgages have a 7-8 year average life, so you'd go out and borrow 7-8 year, 10-year money and fund mortgages that way. But that's unlikely to be as attractive for a bank as just doing what they're supposed to do, take the deposits and turn them into mortgages.
There's another question over there. Go ahead. Yeah.
I'm Mohammed Tahir. I'm responsible for financial compliance for Syngenta, which is an agribusiness company. My question is that you mentioned 3 key questions, you know, which kind of define your culture. You know, the client interest and the economic value Citi creates, right? So how do you measure your performance on that? You know, what are the indicators and how do you know you're making progress towards that?
Yeah. So I think that's a very good question, and there are at least 2 ways in which we try to get at it, and there's a third way, and let me just take you through that. First is we actually poll our clients, both on the retail side and the institutional side, asking questions that lead us to understand how we've been serving them and what their perceptions are. So for example, on the retail side, we have something called a Net Promoter Score. A promoter is somebody who would actively tell somebody, without us asking them, hey, this is a great bank, you should be doing business with them. And you subtract from that number of people who would be detractors saying don't do business with them. That's really important. It's one measure, it's statistical, but that's not the only measure. There are others on that side, and similar interviews and measures on the institutional side. And you ultimately get it in terms of, you get a lot of very textured feedback on these to help you assess what you're doing. And by the way, it's also measured by the kind of business you're doing with that client, whether you're doing more business with them rather than less, those kind of things. The second is we have a very detailed risk assessment. I think it may be 6,000-7,000 people that we put through a very detailed evaluation on a risk basis. These are principal risk takers and principal decision makers inside the organization when it comes to some of these questions that we talked about. And we evaluate them on how they did. And very often, you know, if the answer is, you will find transactions that people do that don't fit that mold, and they'll show up on the risk metrics that we have. And the last thing is the evaluation performance compensation plan. And there are managers who are evaluated. These are 360-degree evaluations, meaning every person is written about by people who work for them, people who work with them, and people they work for. You get a very complete picture on that. That's how you get at it. But ultimately, it does come down to recognizing that financial services is an apprenticeship business, which is people do what they see others doing, or particularly what they see their boss doing. And you've got to train them, and you've got to watch this very effectively to get it to the right place. It's a journey. As I said, you know, you've got all the measures. It's a journey. You just have to keep doing it. You've got to take the tough decisions. If you see somebody not doing it, you've got to deal with that, and they need to have consequences. That's how you get there.
So another hand up there. Yeah, please.
Thank you, Mr. Pandit. My name is Sui Keng. I'm a student in this school. Throughout your conversation...
Perfect. We want a student from our school to ask questions.
That's great.
Thank you. Throughout the history of Citi as a private bank, you've actually financed a lot of grand infrastructure projects such as the Panama Canal, Second World War, and the undersea data cables. And you also mentioned that banks may have since lost their way and used capital for themselves. My question is, should we encourage banks to return to a more public service philosophy, and if so, how?
Well, again, I think the philosophy that you want to make sure your banking sector embraces is the philosophy of serving clients. And governments are one form of clients. And so we've got a very large practice around the world of serving governments. And we do that in a variety of different ways. And in today's transformative projects, for example, are that we work with massive, mass transit systems to enable governments to be more efficient at collections, disbursements, travel, things of that sort. You see some of those things in Singapore that we're doing for the Singapore, the smart system, as an example. But all of that comes out of establishing a need that the government has and working with them to figure out how to do that correctly. And in doing so correctly, you do serve public interests, and you serve them in the right way. That's at the heart of how you go about putting money to work, because you've got to do it at arm's length rates, and you have to do it in ways that are economic to the bank as well, because otherwise it wouldn't be prudent. It wouldn't be prudent kind of lending or the prudent kind of service. We also do other things besides that, and many banks do that. For example, I was just in Washington with the president of USAID. USAID is the largest agency in the US that provides development dollars around the world. And one of the things that we're passionate about is mobile banking and mobile payments and what that represents to the world. There are 2 billion people in the world who have cell phones but don't have bank accounts. When USAID sends money, very often it just doesn't make it through the last mile. Okay? There's a last mile problem around the world where you just can't get at the end user of these services, and you can bring them in. So we launched with them a pilot project in 9 countries where we would create an ecosystem where the government would start paying in mobile payments, where consumer companies would start taking payments in mobile payments, et cetera. What that is designed to do is change the ecology and the ecosystem of financial payments in these countries, so you get financial inclusion and you bring in these people who are on the outside of the economic system, inside the economic system, first step being financial inclusion as well. Now, that's a project which is not capital intensive, but it is a project that is time intensive. It's people intensive. It's very much a project that we are passionate about and we want to do. And it's a project that can change the communities. And by the way, if it really succeeds, we think we can bring $1 billion out of the $2 billion into the banking system. It's not returns driven, but it is really a project that's driven by the fact that we think it's important. And it's something we just want to do. So you're going to find both of these kind of enterprises that banks do. And I firmly believe that if you just do nothing, then to say to yourself, you're here to serve the real economy, you're going to practice the basics of banking, and it's all about serving clients, that's public service. That works.
Since you've asked us to go back to the good old boring days, I'm going to conclude with a very boring conclusion. I think when the history of Citibank is written 200 years from now, I suspect that historians then will say that one reason why Citibank sailed through its 200th anniversary was that they managed to find the right CEO to take over the helm at one of the most difficult times of its history, put it back on its old boring ways, and secure it for the long term. So for that, we thank you very much for sharing with us your insights, and we wish you all the very best for the next 200 years.
Thank
you very much.
Thank you, Kishore. I appreciate it. Good.
Thank you.
Thank you.